All right, folks, welcome to a quick edition of Active Management. We're going to get in that a little bit. I'm Peyton Hoppus, and this is Greg Towner, our Chief Investment Officer here at Parallel Financial. Greg, thanks for taking the time just to really dive into what your specialty is.
Yeah, absolutely. Thanks for having me, Peyton.
Absolutely. Well, let's jump in, Greg. We're talking a little bit about active versus passive management. So, why don't you kind of run through what that means and what that is?
Yeah, absolutely. And I think I'll actually start with what active management is not. Sometimes people hear the word active, they're like, oh my gosh, you're going to be trading all the time. But that's not the case at all. You know, Basically, what we look at as active management is trying to take advantage of opportunities throughout the economic cycle. We know periods go up and down is creating opportunities, allows us to rotate into different sectors and different areas of industries, but also, and very importantly, it also offers us opportunities to manage risk. A lot of times people ignore that side of it until it's too late and then let their emotions get the best of them. So, active management is taking advantage of opportunities, but also utilizing some risk management to us. For certain periods, of course, we've been in this inflationary period right now, right? And we look at different academic studies. We look at when is active management at its best. And it turns out that during inflationary periods is when active management tends to shine. It creates, like we said, a lot of opportunities. Back to the true fundamentals. Things are doing well at certain times, not so well at other times. Certain companies and certain industries are able to take advantage of inflation while others get hurt by it. So active management during this kind of period to us tends to shine.
Well, let's take a look at the visual of that. I love charts. You do too. So, walk us through what that means. What does that look like?
Yeah, absolutely. This is actually a chart going all the way back to the 1940s, coming out of the Great Depression. This is the S&P 500. And you can see there that first green line going up for a long period, 20 plus years. Nice strong bull market. But what happens after those long bull markets is a period of consolidation. That's about a decade or so long there. And the big sustained bull market after that of the 80s came along. That was pushing 20 years. Then we had another decade of sideways through the great financial crisis and all of that. And now for the last, 12 to 15 years, we've had this nice long bull market where everything seemed to go up at once. Everybody in their passive funds, their big cap tech names, everybody's like, wow, everything's going up. This is great. There's a chance now we could be entering another one of those wide sideways patterns that last a while. It's not necessarily a bad thing. We just think it creates a different environment than people have gotten used to. They're like, oh, I could just buy my index fund and hold it forever and I'll do great. Well, if we're entering another wide sideways period, that's going to be more difficult for people to hold those, and they really should be looking for active opportunities to get in on things that are doing well, and importantly, avoid areas that are struggling.
Yeah, we talk about that a lot at the firm of trying to make a decision as an investor, and that can be tough. So I know this next one is you talk about passive investments into index funds and just letting them. So talk through the emotions, and at Parallel, we try and remove emotions for the investor and make a decision for them in the active management space. So walk through what we're looking at here, Greg.
Yeah, absolutely. I mean, we're not opposed to buy and hold, particularly buy and hold passive funds. That's fine if you have a very long time frame and you are actually willing and able to do the key holding part during bad periods. And it turns out most investors cannot. So I know there's a lot of data on this chart. Let's just kind of focus on the top half here. This was a study that was done looking at Vanguard passive mutual funds. For example, those in the value fund, the actual investors in those funds received a return of about 1.9% per year over 10 years, whereas the actual fund itself returned 5.9%. So the investors in the index passive fund only achieved or captured about a third of the actual fund returns. Now, if you go to growth, they did better. They captured 70%, but still not all of it. And then in the S&P index, they captured about half of the return. So what happened there? Well, investors were in this buy and hold, but they didn't buy and hold. When things were great, they're like, oh my gosh, I'm going to put more money in. This is great. Right before inevitably the market rolled over. And then when things got bad, they're like, oh no, get me out of here. I can't handle this pain anymore. So the emotions, this data, and we've seen other similar data, emotions really hurt investors. They can't do the buy and hold for the most part. That's why we encourage investors to find a way to kind of smooth out some of that volatility through active management, Even if even if the active management doesn't necessarily get the market returns, the investor is more likely to get a better return because they're more apt to stick with it over time.
Yeah, I think that's the challenge is everybody has an emotion that's tied to it. So, especially in investing. So, in summary, for active management, really what we're trying to do, we're trying to drive home for the investor. We're setting a discipline for risk management while taking their emotion out of the decision making process and using a process that has a lot of data involved, and that helps us stay disciplined through. Obviously, you saw turbulent times. So, part of that also is making there's certain times of a person's life or investor's life when it makes really good sense to have this really dialed in and really near retirement, or if we're trying to gear up for retirement or we're entering into it, is where we've seen a lot of success in this. It helps control a lot of what the investor feels and sees because we're able to be very active in what they're hoping to achieve out of their portfolio. And the other thing is the volatility in economic cycles can be tremendous. And so we want to help come in, level out some of that volatility best we can. We can't avoid everything, but we also can set in, practices that are not emotionally driven and try and capture as much of the upside as we can while controlling as much of the volatility on the other end when it rolls over. So, folks, this has been just really a summary of what we see in active versus passive. Again, my name is Peyton, and this is Greg, our Chief Investment Officer. If you guys have any questions, would love to answer them for you. Give us a call, shoot us an email. Greg, man, I appreciate your time. Thank you so much for the explanation and running us through some data.
Yeah, absolutely welcome. Take care now.
All right, bye-bye.